Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Welcome, everybody, to Mortgage on My Mind. Today, we have Alan Mack. Alan is a nationally recognized expert in luxury real estate financing. He's been doing this for over 30 years, and he was a top producer at Bank of America, Wells Fargo, Citibank. So obviously the big depository banks that we have in the mortgage world. He's closed over $1 billion in transactions and earned a 10-year 5-star professional award. Now, the founder of Mack Financial Services, he provides concierge lending solutions for high net worth clients, specializing in complex financial planning and exclusive lending structures for multi-million-dollar properties. So welcome, Alan. Thank you so much for being here.
Thanks for having me, Natalie.
Yeah, totally. I do always say that the big loans that need to happen, that's not the kind of loan that I do. Those aren't the contracts I get into, because somebody who's buying a $10 million house, putting $5 million down and wants a $5 million mortgage, they're going with their bank for that. Because if they have $5 million down, it means they probably have about 10 million in the bank, right? Or more sometimes. And they're not going to go with somebody like me, even though I can shop it around and do well with it. But that kind of super jumbo loan, they're just not going to get the best deal with me. They're always going to get, with their relationship financing, a much better deal with their bank. So tell me a little bit about what you offer and what you do, because that's basically that, but it sounds like you are a broker for that.
Yeah, I'm actually not a broker, and I'll explain a little bit about it. So I
Yeah.
left Bank of America in March of 2020. I was with the big banks, as you mentioned, Citibank, Wells Fargo, and Bank of America as a former executive, and I did very well with those banks. One of the top producers in the nation for those banks, and I really enjoyed my time with those banks. One thing I always found as an issue at these banks is that when you work for one particular bank, because the loans are what's called portfolio, they keep them on their own books. They're not sold to Wall Street anymore. They underwrite to their guidelines, to their product and whatever it may be. And depending on how much they have in depository relationships that they have that they can lend out. There's a lot that kind of goes behind the scenes with the banks. So when you're with one bank, if I have 5 people that walk in that door, I might be able to close 2 of those 5. That means that 60%, maybe even 80% of my clientele are going to do this loan with another bank. And the reason being is because maybe that bank doesn't go high enough loan to value, which means less money down, or their rate is too high, or their guidelines are really strict on maybe FICO scores or reserve requirements. Whatever the case might be, each bank is unique in what they offer. And so I know these guidelines for these banks as being a former producer and a top producer. I kind of know the bankers in these banks, we'll call it, right? So we kind of all know each other. A lot of my friends will be at one bank and that bank changes and then they go to another bank. So we know each other. And I created this network of these amazing mortgage bankers inside these banks and understand their guidelines, their products, what they can do, what they can't do. And I even negotiated with such things as pricing exceptions and relationships and so forth to help that client really maximize on that relationship. And so these banks can't advertise what they do. And it's really unique with some of these banks. They have some really cool products. I have one bank right now offering a 2-1 buy down. I get a start rate in the 3s. And it's the only bank will do it. One bank in the nation that does this. And
Who is that? Just curious.
I can't say it online.
Oh, do you not too? Because then they go right to the bank. Yeah, sure.
Yeah, they come to me. And so what I've done is I've created, like, if you think of a needle in a haystack, it's like, where's that needle? And when you deal in the wealth market, 95% of my clientele are, one, very famous, or they're very well-to-do, and they write off everything. There'll be a C Corp, S Corp, LLC, whatever it may be. And their overall goal is to pay as little money as they can. and taxes and so forth. So it's great in that instance. But when you go to borrow money, you have to qualify for these loans. And so in many of these banks that I have, I get creative with these banks. And so we can use asset depletion, cash flow analysis. I can use other assets they have and create income out of that. But it's really cool stuff. Not all banks will do this, but I do know the banks that will do this. And so basically, when I sit down with that client, I look at their overall portfolio, basically a personal financial statement. I'll look at their REO, what they have in real estate. I'll look at their assets, liquid, and then their non-liquid assets. And then overall, we figure out a game plan. So what is their goal? I want to buy that $10 million home, and I want to put as little money down as possible. And they have certain requirements, and that's fine. Or they're going to pay cash, and they want a technical refinance to get their cash back. So those are things that basically I sit down with that client, and then I go over their portfolio, so to speak, and I help them acquire the best financing for their need, not the bank's need.
Right, exactly. Interesting. And so we were chatting a little bit about the intricacies of this and figuring out which bank to take where, which file to put with which bank and what makes the most sense. Just from my understanding, who would you say is the most lenient on a true self-employed, not showing much income on the tax returns person?
That is a really loaded question. So I have a few banks. There's a couple out there. And what we'll do is I just got done closing, give you an example. I'll give you a perfect example. Just closed a
Right.
transaction in Balboa Island is right next to Newport. And for your audience, they may not know that, but Balboa is a beautiful area of Newport area, and bought a property. And he sold his company a couple of years ago, and he walked away with $25 million. Now he's 71 years old, so he's a little older, and he started a new company 6 months ago that they're going to take in public and so forth. But he can't show the income today. And so he needed to finance this
Right.
$7.1 million property in Balboa that was under construction. And this file came to me. And so we were able to put him through one of my banks. We basically were able to create income from his assets, and along with some other things that we can get in creative to get him
So you
financed.
did
But
like
long
asset
story
depletion.
it was asset depletion, but we use the assets not so much depleting them as you think that way, but basically creating income, right? And so you get creative on how you structure it and put it together. But we were able to have them come in with, you want to come in with as little money as possible, because guess where his 25 million was? Like most people that are affluent, it's invested. And they don't want to have to sell that stock or sell that asset, pay the capital gains, and
Course.
then put it in four walls where they can't make any money on, right? They're trying to maximize their overall cash flow and liquidity.
Mm.
And the long story short of this, we got him in a $7.1 million sale with only 14% down. And his FICO, unfortunately, when credit was run, not knowing this as a client, and it happens a lot with affluent clientele, he has 681 FICO score. And in the banking world, that's extremely low,
Wow.
especially when you borrow money like 4 or 5 million or $6 million. You want to be a 720 FICO. Those banks want to see you got a good FICO score. So he had a rolling credit card, didn't know about it. He had identity theft a little while back, a couple of years ago, and it affected his FICO score overall. So we were able to get an exception with the bank and still getting amazing pricing. Got him a rate in the mid fives, I believe it was like 5.625 was his rate he actually got on a 10-6 arm with no points, and without any
Wow.
FICO score being as low as it was. So those are the kind of things I do. They come to me, and this client can't be any more happy than he is, because he would have to pay cash for this home. If you went to any other bank and
And
walked in their
why
bank,
14%? That's such a random number.
because we were able to maximize some of the assets he had along with the 65. So I had a 65% loan to value first. And then I maximized some of his assets, had moving them over, and we borrowed against it through a pay lock. And I was able to get another $1.5 million. So we only came in with 14% down as a down payment. Remember, his overall goal was not liquidating his stock and taking it out, paying capital
Got
gains,
it.
paying as little down as possible.
So
And
you
I
pulled
met
a
that goal.
margin line.
Correct.
You pulled a margin
Yeah,
line. Got it. Got it.
exactly. And able to
Yeah.
maximize less down, because that money's sitting there and he's got to invest. He's not going to touch it. Absolutely.
Right.
So just getting,
Right.
that's it.
Yeah. I have one that was very complicated that we're working on getting docs out right now. We got clear to close today, but it was like over a $3 million purchase, which is for me a bigger purchase,
Oh,
for
absolutely.
obviously
Absolutely.
nothing. And he's putting $1 million down, and he has 9.5 in the bank. And he has no job. None. He's not working. So 8.5 of the 9.5 are stock options. And some of them are exercised, some of them are, right? So that's where it got super tricky on this file because all of my investors wanted him to either liquidate or have them
Yeah,
exercise or only
yeah,
what we ended up having to do and like struggling through 100 different investors that I like called and went
yeah,
through.
yeah.
We were only allowed to use 50% of the stock option. And we were able to make it work. And he had to liquidate the million from the stock options so that
Yeah.
I had a million still sitting in cash after they wanted that. But what in it like what a crazy sitch that was trying to get some.
It's how it is, Natalie,
Yeah,
in the fluent world or the luxury world. It's like that. It's extremely creative. It isn't cookie cut like a Fannie
yeah,
Freddie conforming W-2 and they're, you know the story on it, 2 months bank
yeah,
statements, everything's perfect. Here it is. It's wonderful in that world. But when you get into self-employment and that luxury market, it gets extremely complicated. That's where you got to get creative. And the client, in all honesty, if you think about it, what's more important to them than anything else is their time. They have the
yeah,
money, they've got everything else, but they don't have the time. And so they're relying on people that are going to give them the right advice and that's going to be able to basically help them in their position, whatever it may be, whether it's liquidity, whether it's a lower rate, whatever it may end up being. They want to make sure
yeah,
that they're getting the best they can get.
yeah, yeah. It's true. It's an interesting, I love it. I specialize in non-QM. Like that is my jam. I
Mm.
like, do a ton of bank statement only loans for my entertainment buyers and things like that.
It's a
Even a
great product.
guy,
A lot less hassle. It's a great product. No
it's
question.
such a great product. The rates are low now. They used to be really high to where it
Yeah,
was a big difference for people that it shied them away from the product because I'm not going to do 8% just because I don't file my taxes in a certain way. And now you're like, don't file your taxes in a certain way. If you file your taxes in the way I need you to qualify you, you're going to spend like 80 or 90 grand in taxes and what you're going to owe for me to get the income I need on the file.
absolutely.
The
100%.
rate's going to be like a 1/4% higher for me to go bank statement only, which is like $180 more a month. So like, how can we even talk about this? Is like a $2,400 difference a year or 80
Yeah,
grand in a tax fee. So it
yeah.
like, and then you get them out of the non-QM loan at some point,
Yeah, and
whatever.
that's the thing. They can always refinance. That's the
Exactly.
beautiful thing about doing the loan, right? You're buying the house. I always say you're buying the home, not the loan. So they call it whatever they want on that. But the reality is that you're moving in and buying that home, and you're going to refinance one, two, three. You can. I refinanced 9 times. I've lived in my
Oh
home
my
25
God.
years, but I have a 2.5% 30-year fixed rate now.
Yeah.
It didn't start there when I bought the house. I'm not going anywhere. I love my home. My wife and we're not going anywhere. I live in a very beautiful area.
Yeah.
I took advantage of it. But it's with clients, I tell them this, you go to refinance, it's a lot cheaper than it is when you go to purchase because your escrow and title is very expensive when you go to purchase. When you refinance, a refinance is if it's $1 million loan, it's around 4 or 5 grand without
Okay. Yeah.
impounds. And if they don't do impounds, it's it to do a
Totally.
refinance. And you roll it in the loan. So it's pretty easy. But
Yeah, exactly. And none of these products anymore have prepayment penalties and none of them like I don't I have 6 different non-QM products in-house that we directly underwrite and fund. So I don't even need to broker them. There's no broker fee. So I can
right,
quote them
right,
0 point rates and it's just so
right.
much better. And the rates are in the mid to high sixes.
Yeah,
I know that's
exactly.
high for you, but for a
But in
non-QM,
your world, it's trust me, because I know in Fannie Freddie world, it's like in the mid sixes anyway, you know,
totally. So if
and you
I'm
got to
in like,
qualify.
and I'm
So
at 6.8 on a bank statement only,
it's a no-brainer.
it's a no-brainer to go that
It's
route.
a no-brainer.
Yeah,
In your
yeah,
world, it's a no-brainer. Yeah,
yeah.
absolutely. And
That's
I'm
why
all behind non-QM. I don't really never did non-QM. I did them for a little part of my career, but basically my overall experience has been with the banks.
hard at banks. Banks don't do it at all, right?
None. No banks. That's the thing about banks. You could have great credit. You have to have reserves. You got
Right.
to qualify, whether it's through assets, whatever it may be. But it's much different. It's
Yeah,
A paper. We'll call it prime. You look at non-QM. It's different. It's like the old world
totally.
subprime, but because it's not prime, and you're going to pay for it at a higher rate, but you're not going to go through the hassle you're going to go through if you go to qualify.
Yeah, yeah. I was at B of A for 2 years.
It's like you got to
It
get every
almost killed me.
cross
It
your T's,
almost killed
dot
me.
your I's, and do it over and over. And that's the beautiful thing. What I do is that I know what bank they're going to have the least amount of resistance in getting that transaction done because the banks are all so different. They're in and out all the time, and it's very unique. I'm gonna tell
I
you.
know. It's so funny with depository banks that it's like for a while, Wells Fargo doesn't use K1 income. And it's the most incredible thing to me
But
that
that's unbelievable. That's like a 1099, and you're getting it from your corporation. What's
you're
left
still
over, you get
paying
that
taxes
income.
on it. I'm like,
Of course.
that doesn't actually make sense. It's filtered through onto the Schedule E and he's paying taxes on this income.
Yeah.
It's not logical, but they're like, it's not his income, it's the income of the company. And I'm like, not when it goes to his personal. You
Of
can't,
course,
the
he's got to pay tax
logic.
on it. Personally speaking, it's whatever. I heard that too, and that's why, in all honesty, I don't. Very rarely do I bring clients to Wells Fargo, and they're a great bank. I used to work for them. They're a really good bank,
Yeah.
but they're tight. The big box banks,
And
you
not
got
logical. That's what it
it's
is. It's
it's
like,
they're gearing more towards the cookie cut non-conforming borrower, and that's someone's buying a $2 million property, putting 20% down. They make W-2 income, maybe well in the six figures. They have assets in their 401k,
totally.
the story. So that's what they like. And if they deviate outside the box in any way, I've had a client that we closed last year that had a 5,000 page tax return. And the bank he took it to, which was Wells Fargo, was turning it down by chance. And so he came to me, and I got it to one of the other banks. We found income on page 480 of the tax return. It was about $2.5 million. That if you superficially went through that tax return, imagine a 5,000 page return.
Yeah, no,
Okay, your head will spin. Your head will spin. You know that it's like a telephone book, right? And
the,
so my
yeah,
banker found that on page 480. He was a previous underwriter. He's got experience like no one has, I swear, in this industry. And I found the income and we closed it. It was a 13.3 purchase in the Strands down in Dana Point. And we came in with, I believe it was like 25% down on a second home. It was like maybe 30% down. Anyway, and that was another thing. They wanted another $2 million for a down payment on that same client. And I was able to get him less down, $2 million less down. And without
yeah.
the hassle, we got him done. So he was very grateful for what I offered because in essence, he was in contract. When they have money, it's like they don't like to hear no. I'm just being honest. It's because
No,
they're used to,
totally.
they've got the money. They can pay cash for it in many instances. And you turn
Totally.
me down, and I deal with that. And so my job overall is to make sure that they're going to the right bank and have a great experience. But in this instance, again, my banker knocked it out of the park. And we found the income. It was, I never forget this, on page 480 out of a 5,000 page tax return. So anyway, they
Yeah.
get
Yeah.
complex.
I know. I once had a file that was the biggest tax return I'd ever seen. It was like 1,035 pages, something like that. He buys and sells corporations. And at the time, he had 52 K1s. So he had 52 corps. But the good part was it was like 27 were final. So didn't need those. And then, but the 24 or whatever were brand new.
Just got one. We just originated last week, 200 plus K1s. 200. It took my
Wow.
banker all weekend to go through every K1. It was like 225 K1, something
Is
like
that
that.
through stock, like a BlackRock kind of K1 or full
I don't
company?
even know. And the thing is, like
Okay.
I said, I'm an advisor, consult for that client. I don't get involved with doing the loan. I'm not the bank. I work for them and helping figure out where we're going to go. Let my banker work and do that. That's their job. And they know their bank.
Yeah.
They know what their bank wants and what they don't want. And in some instances, we don't need to use K1s if, even though they have them, if we can qualify them with a lot less of their K1s and their income to use, why get it all? You know that. I
Right.
mean, it's just right. It's just, we don't make it more complicated than it is. So that's the overall goal. Make the
Yeah.
experience in the banking world different than the non-QM world, which is easier and bank statement product. The banking world a little more
Totally.
difficult. Make that experience as best you can make it for what it is.
Exactly. Exactly. All right, so let's switch to talk a little bit about like real estate market, the luxury real estate market. Like how have luxury trends changed or evolved, let's say since COVID that you've seen? Because that's when you started pushing into it more.
I pushed heavy in it in 2022. That's when I really started pushing heavy, and 23 just took off with it. I will say that I think during COVID and when the rates got down to twos and threes, the overall market was just crazy. And the luxury market was off a little bit more than the regular market. Regular market had people standing in line taking a number. And then after 2022 and the rates shot up, we started seeing the conforming world start to really slow down because of the liquidity, high interest rates, whatever. And then I started seeing the
Mhm.
luxury business pick up. And that's the other thing. It started picking up. So as rates went up, believe it or not, the luxury market started to pick up. And I think of it this way is that when you think of someone that's got liquidity and they're investing in their money today, they're making at least I'm going to say a 5 to 6% yield conservatively on their money, conservatively. And so if the rates are at 6%, it's almost a wash. And so when rates were
Right.
at 3%, it really helps that first time home buyer. It helps that the overall market, we'll call it the general market. But it didn't really light the fire with someone that has money because they're on their investments, they were at the time when making maybe was 3, 4%. And so it's all relative. But I can tell you since maybe 23 and 24, and now coming into 25, the luxury market has really picked up. Multiple offers, creative on selling the property, whether it's through concessions to help them pay for all costs because they knowing that maybe they're going to refinance in the next 12 months that many of us are believing is going to happen. You're going to see that in the conforming
We're
world,
going to
right? In
just
your
keep
world,
believing that. Yeah.
and it will happen. They have to get interest rates down. You see this administration really pushing interest rates to come down.
Yeah.
Overall, it's like they're going to refinance. And by the way, if they start with this bank, when they do that purchase transaction, I would tell them 6 months when the rates start really dropping, I said, look, we may not go back to that same bank. If it is, you have at it. It's yours and feel free. But I'm going to tell you, maybe another bank because it's a refinance now. So some
Right.
banks offer promotions as when you do a
Right.
purchase transaction, they'll take 1/4% off that rate. When you do a refinance or refinance cash out, the rate goes up. And so you got to know which bank says, no, we'll give you the same pricing we do on our purchase. And some banks do that and some don't. So I know, like I said, I know where that needle is in the haystack. I find it.
And do you find that you're seeing more people, this is going to sound so simple and silly, but more people with just a lot more money because the market is up so much and people's portfolios have just been growing in exponential ways in the past couple years? Are you seeing a lot of people with big portfolios and
Yeah, absolutely. In the last couple of years with the stock market
right?
again increasing and some of these in crypto, I'm going to tell you, crypto is another one I'm starting to see big time now with the affluent market investing in crypto. And this administration likes crypto. Yeah, I think overall with people's portfolio, and I'm being really conservative here. Most of my clientele make it's well north of 7%. I'm going to tell you an interest rate. If you look at their portfolio and the way they've invested. And so,
For
again, it
sure.
goes
Oh
down to the
yeah,
financial
easily.
planner and their advisor. I don't get involved with that. I'm there to help them on the financing side, whatever it may be that they need to get financed. But when it comes down to the investments that they make, that's up to them and their stockbroker, whoever they've got, or their broker they use. But
Yeah.
I will say that the yields and what they're getting on the return on their money is pretty substantial. That's why they don't want to liquidate that money. They got to pay capital gains, and then they got to take that money and put it in those four walls. So then there's that perplexity, like, okay, I'm going to come in and pay cash so I can beat everyone out, try to get an extra 200,000, 300,000 off on the sale, and then they got to figure out, okay, how am I going to get my cash back? And so I have a solution for that, but that's the reality overall is that
Sure.
they're making money right now. Absolutely.
That's
Yes.
like you pull a margin line and then you pay back the margin line kind of thing.
How are they doing it? They pull a margin line
Yeah.
or they're just, or they're actually liquidating. I don't know. It's whatever they do
Yeah.
because their
And
margin line is going to give them maybe, so if they go to buy a $6 million property, they have to have at least 15 million in assets or more. If you think of it that way, the reserves, and
and
you
go
know,
ahead and just explain what a margin line is to the audience, just in case somebody doesn't know what that means.
sure. So let's say I have $10 million in treasuries. And by the way, the banks love treasuries because they're very stable. They like a secure asset. So whether it's a particular stock that doesn't move that
Does
much, or,
well. Mhm.
yeah, they're very well, like an Apple stock or things like that, or treasuries or money market or CDs. They'll lend up to 95% on money market and cash or treasuries. They'll lend up to 95% of that asset. So if you got 10 million sitting in treasuries, what you can do is you actually borrow against that through what's called a pay lock or a margin that you're going to do a line of credit against your assets. Your assets don't move, they stay where they're at, and they get a line of credit against that. And so,
Right.
depending on what they have for assets, because some stock assets maybe only get 50% against that asset for a margin, others can go
Totally.
up to 95%. So,
Normally,
depends
I
on
advise like it's 50% of the portfolio, just as like a
that's really
standard.
conservative. Yeah, yeah, it's higher
Yeah,
than, but yeah, if you want to use a conservative number, that 50% is definitely
as a
very
standard,
conservative.
yeah. But
Yeah.
it's so people understand like a mortgage is a loan that sits tied to a home, right? So it's collateralized. The reason the person's giving you that money is because it's collateralized against this home that's an asset that's worth money, right? So that's why you get a mortgage because that's what it's collateralized against and sits tied to that home. A PCL, private credit line, margin line, what we're talking about is actually a line of credit. It's not a mortgage, right? It's not tied to a home. It's a line of
Right.
credit tied to your assets in your bank account. Because a lot of people don't know what a margin loan is at all. Like when I bring it up to people, they're like, what is that?
So I'll give you
Um,
an example of one of my banks right
and
now.
we
They
get
offer
our
five.
down payments from it. We get everything
Absolutely.
from it because the rate on it is always a little bit less. It's not
It's about 5 now. It's about 5.7%.
exactly a little bit less.
Just over.
And I don't have to count the debt against you
Nope.
because it's collateralized against your account that's earning money that pays
Right.
it through the cash or dividend or whatever that comes in. So go ahead, you were saying.
I was going to say, so for instance, if they're borrowing the money at 5.7% and they're buying that house, yes, the house loan free and clear, we'll call it, because they've taken that line of credit that they paid cash for that house. They're able to basically offer cash. You see that a lot when you watch like $1 Million Listings, other shows. They're paying cash for that. They're doing a line of credit against their assets. But
Exactly.
behind the scenes is they're trying to figure out, okay, I want to get that because they may need that line for other things, other investments, maybe a company they want to buy, whatever it may be. They
Yeah,
have other I work with it all the time. I deal with that. So their goal is like, hey, I want to get that line paid down or paid off. And I go, and I got that asset sitting over here that I own free and clear, which is four walls. Let's figure a way to get my money out of those four walls and then get that money
exactly.
back out through what's called a technical refinance. And then they take that money and they pay down or pay off that line of credit. So now they got their
Totally.
asset to do whatever they want to do with it again. So it
Yeah.
frees up that money. So anyway,
Like
it's a
delayed
great way to get
financing.
creative.
Yeah,
Yes.
yeah. For me, it's more like I have somebody who has 400,000 in a portfolio and it's all tied up in stocks. And they're willing to buy $1 million house, but they're only really willing to pull like 100 grand in stock because the market's doing very well and they don't want to liquidate that account. Of
Correct.
course. They're also going to pay taxes on it when they liquidate.
Correct. Yep.
So it makes so much more sense to them to liquidate 100 grand and pull a margin line of 100 grand. And that way they can still do their 20% down. And that's why these margin lines, they're just an incredible, I was going to say asset, but just,
It's a way to get, you know what it is?
it's a
Honestly,
way
man,
about
it's a
pulling money.
creative way to get someone into a home without taking that money, that $200,000 out of their asset,
Yeah,
liquidating it, paying the tax on it, putting it in four walls. So now
yeah,
that 200,000 is sitting in those four walls, you can't touch it, you can't invest it, you can't do anything with it. You can touch it as a wall, but that's about it. Instead, you put less down, you put 100,000 down, keep an extra 100,000 over there, which is making you a 7% yield or whatever it is on that
right.
7 grand in income, if you think of it that way, right? So now you're making money sitting in here versus in a house, it doesn't make you money. It's again,
Well,
it's how
yeah, it's an appreciation, but not,
no, again, it's going to appreciate no matter what, right?
yeah,
Whether they have a lien or don't have a lien, the home is still
true,
appreciating, right? So it
true,
doesn't, the asset's still appreciating. So it doesn't affect the asset. But what it
right,
affects is their liquidity and their opportunity to invest. That's
right.
what it affects. So that's why if they can pull it out of those four walls and get it back in their pocket, they're going to reinvest it again. So
Yeah,
think of it that way.
exactly,
And
exactly.
by the way, and I'm going to get them a rate in the mid fives on that home on a refinance. If you look at it, or maybe low fives, and they're gonna invest that money. They bought it 5 million, they want 4 million out, put it back in 4 million. They're gonna invest. They're gonna make a 7-8% return on that investment.
Totally.
So it's a win-win.
But you're only going to do that if they have millions of dollars in the bank.
Everyone's different. Yeah, exactly. Most of the clientele and almost all the clientele I work with, yes, they
Yeah.
definitely have a few
Just
million
want to make that
plus.
clear to the audience because
Yes, yes. If you have,
yeah, the
again, it's my
banking ones
market I
are
work
high.
in. It's the luxury market overall. It's getting really creative in that luxury market. Yes, it's different.
Yeah, totally.
Totally.
What would you say, like, what should a real estate professional understand about this kind of hierarchy of banking?
I think overall is there are real estate agents out there that work in the luxury market that may have a banker that they work with. They like John Smith at ABC Bank. And they like to refer John Smith at ABC Bank as much business as they can. And it's great. That's wonderful. And it's being loyal. The only issue is, did they do right by their client? Meaning that yes, John Smith at that bank, and it's a good bank, but was it the right bank for your client? That's the thing.
Mhm.
And I will share with you again, like I said, being a former banker, is that the chances are highly unlikely it's the right bank. Highly likely it's not the right bank, put it that way. I'll tell you, the odds are in the favor of not being the right bank. And because again, I see these clients come back to me, I know what their bank offerings. I know all the banks, I know what they've got, what they're offering. And so, yeah, John Smith works at ABC Bank. It's great, but you're pigeonholing your client into one bank versus saying, hey, here's John Smith, and then again, here's Alan Mack at Mack Financial as an example. And listen, I'm all for that client. If you can find a better rate, a better program on your own, have at it. Please have at it. I don't charge an upfront fee. I get paid at the close if you use me for my services, but have at it. I wish you the best because I know it's out there. And so I'm gonna tell you, I haven't had a client literally outprice me or outdo me as far as even service in reality. So they come back and go, wow, how are you able to do this? I said, because I know where to go. I know who's
And that's
offering
why
that
I said at
special
the
today.
beginning, you're a broker for the luxury. Now I
For
know
the
you're not,
client. Do you think that that's the client? I work for the client in
you
essence.
work for
I'm
the
not a
client, right?
I work
You
for the client
find
as an
the
advisor. I
best
just know where
bank
to
for
go.
them.
Yeah.
You find the best bank for them, which
I
to
find the
me,
best man. I know where to go for what they need, their particular need. It's kind of like a shopper if you think of it that way. It's like I need a suit. Where's the best place to get me the best quality suit for the lowest price?
yeah.
I'm a personal shopper if you think it that way. But again, my bankers, what's really cool is that the service they provide for a bank is unbelievable. It is unbelievable. It's literally a red carpet concierge service because they know the client I bring. I tell them all I expect from you is immaculate and great service, just the best service
Right.
possible. That's it.
But they have to move their money over as well, right?
Not always. No, no, not always. Again, I use that as an ace in the hole. So some banks like a relationship. They want you to move money. In fact, some mandate you move money.
Right.
Others are like, you don't need to move anything. We just want the relationship, meaning that we want to be able to work with you as maybe your business, bringing your business or whatever it may be. We want you as a relationship to build with you. And others say, we don't care about anything other than the fact to do your loan. They're all different. They're all different.
Interesting.
And I know
Yeah.
where to go. Where, okay, because some of these banks, you get into over 5 million, especially, they want money moved. And the client may say, hey, Alan, I really don't want to move any of my money. Can you get this without a relationship? Okay, let me work on this. I'm just being
Yeah.
straight. It's because they'll call the bank and start the process. They go, oh, you need to move over $1 million. After you're going through the process, you want to know that before you even start that process, as an example,
Totally.
right? And I
Yeah.
know that.
Yeah. That's what happens with clients that I'll pre-approve that have a lot of money in the bank. I'm like, oh boy, I'm going to pre-approve them. I'm going to spend hours and hours on the phone with them explaining the process and taking them through numbers and blah, blah, blah. And the moment their bank finds out they want a loan, there's not much I'm going to be able to do about it because they've got 4 million in the bank. But what happens is they end up like talking to somebody and this and that. And then they're like, whoa, no, they wanted us to move 2 million into this account, or they wanted us to get the craziest part, that thing that I heard on a loan that I lost, but it was a $6 million house. They were putting 2 million down. It was the $4 million loan. I was like, this is so not mine, and I'm not really getting my hopes up here. But they ended up being told that they shouldn't put as much money down. Like the bank wanted more money in their portfolio, and they wanted them to put less money down specifically, and they wanted them to carry a much larger loan so that they could keep working on the portfolio instead. And that was a strategy that they convinced them on, even though the buyers, when I had spoken to them, were very monthly payment conscious. But however they were going to work the
Yeah.
finances of earning them money monthly in order to pay that monthly, whatever, it was a
I
trade-off.
look at it this way. Here's what I do is I look at the overall their portfolio and thinking about, okay, because I have clients all the time. I want a lower payment. I go, I'm sure you do. If you want a lower payment, why don't we go with interest only loan? You want a lower
Mhm.
payment and put less money down. I said, what are you making on your money? 7, 8, 9% yield on your money. So you want to put an extra $1 million down. That's 90 grand or there's 80 grand in income. If I took that per month, that's 7,000 a month. You have difference in payment and you're getting a rate at on interest only, I'm around 6, call it around 5, 7, 8 to 6 and 8, depending on the bank and so forth, the relationship, which is, I got one the other day at 5.625 on an IO. But again, which is great. So their
Yeah.
investment is most likely making more money than mid fives, right? And so when you pencil it out, again, being a real advisor, you pencil it out side by side and go, listen, you can always pay down your principal balance. Always. And the banks, we only do 7 and 10-year arms. They have 30-year fixed, but they're terrible. I always tell clients, don't even think about it. The rates are crazy. They're high. They're really high on a 30-year. The banks don't like them. They like 7 and 10. And the reality is when you put a lot of money back down on the principal balance on a 7 or a 10, what's it do? It recasts. So you actually lower your payment. And so the reality is if you want the lower payment, hang on your money right now. And if you feel like, hey, I want to get ready to retire, I want a lower payment, whatever it may be, you're not paying taxes anymore, you're paying less than taxes, yeah, take that money and put it down against your loan. Your payment's going
Mhm.
to drop without you refinancing. And then if you decide you want to refinance, refinance. Put more
Yeah.
money down. So it's always available to you. Like I said, you start here, because if you start low and go, oh my gosh, I need, how many times this happened? It's happened to me in the past where a client will put as much money down on the house as they can and all of a sudden they lost their job or something, they got sick or something happened. So I can tell you a story of a client I'm working with right now that is an unbelievable story. Palisades lost this home was like 100 million plus, they had a home burned down and just really took a hit. And it happens. People's lives, things change. I said,
For
and I've
sure.
had clients that put their money in four walls and then something happens, then they can't qualify. And they need the money so bad. And I'm going, I can't do
Mm-hmm.
anything for you. I told you before, hang on to your money. Cash is king. Let it work for you. If you ever want to pay it
Totally.
down, fine. But if you need that money again, we got to refinance your house, or you're going to, in this instance, sell. And it's hard. It's a hard thing to tell a client. And so for me, it's, yeah, that's why the banks will push and say, listen, why don't we go with a higher loan amount, take some of your asset, invest it with our bank through our financial wealth management side or private banker, and we'll
Right.
let that money work for you. And you can always pay, like I said, there's no prepayment penalty. You can always pay that loan off, pay it down, recast, refinance, whatever it may be.
Exactly. And tell me, we spoke about it a little bit about little known bank programs that somebody with high income should know about. Like if they already have high income, so the non-QM stuff isn't necessarily needed, but are there programs that like a high income borrower
Yeah,
know about?
so the banks are all unique and different as far as their down payments, right? So when you think of a $10 million property or $20 million property, they want to put that as little as possible, right? So I know which bank I can go to 70%, maybe to 10 million, right? 30% down. Most
Mhm.
banks it's 50%, 55, 60%, maybe 65. So I'll know where to go. I know which with my bank. But I'll tell you what's really become very popular right now. One of my banks is really, really good at this. It's called an OTC, or one-time close. And so because of the fires in Palisades, I've got a lot of clients that I work with that have lost their home in the Palisades, want to rebuild again. And the issue is that they need to get financing to do a construction loan. And so I have a bank that will basically lend money on future value, different from loan to cost. So I'll give you a really simple example on this. And so let's say I bought a piece of property, I paid $1 million for it, and I financed it for that matter. And so I financed this $1 million piece of property, and I got a, let's call it, I got a $700,000 loan. I got 30% now, so I almost owe 700,000. And then I want to build on that property $1 million construction loan. So I'm into the property total for $2 million, right? But when it's all said and done, that property may be worth 2.5 million or $3 million, right? When it's all said and done, future value. So when it's built, it's done, future value, it's a $3 million home. And so getting a loan on future value is that I can get up to say 70% loan on future value. So let's say that property future value is going to be $3 million. I can get
Okay.
them back $2.1 million to pay for the land and pay for all the construction costs. In essence, it's like 100% financing. So it's a way to get creative, different from loan to cost. So look, the same example, loan to cost, $1 million and $1 million. So they're into it for $2 million. The cost of construction is $1 million. So they lend on the loan to
Mhm.
cost, meaning the loan total cost is 2 million. They'll loan maybe 75% of that. So they'll give you $1.5 million loan versus a $2.1 million loan. Because
Right.
now they come in money for the difference. So in essence, that's why it's much better if you can go loan to future value versus going loan to cost. And I have a bank that is really good at that. And the rate, by the way, I think is around
Oh,
5 to 7 8.
interesting.
And it through the construction phase, interest only. And then after construction phase, it goes right to a fixed rate mortgage as a 7-year arm. So if there's 2 years left, it's either 15-month or an 18-month build. Whatever's left on that 7 years, they fix it at that, and it's there for the rest of the term of that 7 years. So if it's a 5 7/8 rate or 5 3/4, whatever the rate is, then go to P&I payment once it converts to that permanent financing. And they don't have to do two loans. It's one
Interesting.
loan for everything. So it's one loan.
Yeah, I've got something like it, but not at that rate at all. And it's not at that rate because they can do 90% LTV,
Yeah.
ground up construction. Is that something similar? Like they can do
Same thing. Same thing. Yeah. The rate's going to be
yeah,
different.
yeah,
Yeah. Yeah. So my world is they're building a 2 million, 3 million, 5 million, $10 million property. And
right.
so with that, you're putting more money down, of course.
Exactly, exactly. Because we're looking at, of course, in Altadena, a lot of lots right now.
Yeah.
So I'm working for the first time on ground up construction since I was at Countrywide. We had that at
Yeah.
Countrywide.
Yeah. Yeah.
Crazy process. But since then, this is my first true ground up, buying a lot and doing a loan, everything in one. So we're buying the lot for him, 500,000. He's going to do a 700,000 renovation. So we're giving him basically 1.2.
Yeah, yep,
Yeah.
yep,
Yeah.
exactly. Yeah, renovation loans or ground up loan, whatever it may be.
Yeah,
Got it both.
totally.
So typically on the ground up, they have to have permits ready to go. So they can start the loan process, but they can't really move forward with anything until they get the permits. So I
Yeah.
always recommend get the permits first, and then we got the financing for you.
Yeah. Yeah, totally. Totally. This has been so lovely. Thank you for joining us. Such a interesting. As I said, I don't deal really with the luxury market. Most people would consider $1 million luxury, though, if we're not sitting
It's
in
true.
LA.
Absolutely. Yes, it's
So
true.
like,
Except where I live in Southern Orange County, median home price was 1.2 million, somewhere around there. So yeah,
yeah,
absolutely.
exactly. This was really enlightening and interesting. And I also tend to stay very far away from big banks, which sounds like you are deep within them, which is like enticing for me to understand as it is, because it also feels like you're deep within them and not as a paper as I understand big banks to be. So it's good to know that, because a lot of the time I will have somebody who's self-employed and they don't look good, but they'll say, I'm going to go with Morgan Stanley because they're offering me this because I have $1 million in the bank or something. And I'm like, I'm concerned for you because you have a massive declining year in income from 23 to 24. And your ratios are also at 49. And so it gets me like,
Yep.
I know if I were to try to go through a big bank, it would never go through. But banks are interesting. They'll do a lot for people with money.
And you touched on something real quick now, just to mention it to your audience,
Yeah,
is that banks typically will do a 43 back end ratio. So if you did your standard banks, 43 back end ratio.
totally.
However, I know what banks can go to 45. I know what banks can go to 50. So I know where to find the needle again. So again, and they
Yeah,
may need an extra 1%, 2%, 3% of DTI to get them
yeah,
to qualify. So I know where to go. That's the other thing. And you mentioned that because getting that DTI down enough where it makes the loan work for the bank.
exactly.
Sense.
And we have ways too. So we have an outlet with Goldman Sachs that takes me to 50. I have an outlet with Morgan
Yep.
Stanley, actually, that takes me to 50 and stuff. But it's
50 is, that's
50's,
kind of the cutoff.
unless it's
50
FHA,
is
it's
it.
always it.
Yeah, that's it. Exactly. If it's FHA or VA, whatever, that's it.
Oh my God, yeah.
Not
I
my
clo-
world, that's for sure. It's not my world. 50
no,
is it. So
it's mine for sure. I closed
yeah.
a VA loan, and my DTI, debt to income ratio for the audience, which is a back end ratio, was 65.8.
Wow. Wow.
Nuts. And it's because she had residual income. Residual income is really how you qualify on VA
Right.
anyway.
Yeah.
So there was just enough residual income in there that gave us the approval for the 65. I was like, this is the highest. Are you okay with this payment? Or it's
Yeah,
like,
exactly. Exactly.
do
Yeah.
you feel pressed? Do you have supplemental income I don't know about? Because the ratio is still the
Scary. I
ratio.
wouldn't want a ratio like that, but that's me. So
I know. No, I know. But she did. She has a husband that is
yeah.
not alone because it's VA and blah, blah, blah. But yeah, they're nuts. I need to get somebody on here who's like a VA specialist as well, because those loans are truly like some of the best loans out there.
I've done two in 37 years of my career, two only. So I do not know. I've never done a down payment assistance loan ever. And I've only, I think, maybe done one non-QM loan in my entire
Oh my
existence,
gosh.
and then 10
Oh,
FHA loans in my entire career. And
oh
I've
my
done
gosh.
over 5,000 for $1 billion. So that's it. I was never my world.
Yeah.
I don't know at
Yeah.
all. It's like foreign to me. I have an idea, but
What's
that's
amazing
foreign.
on VA is there's no loan limit.
Yeah, that's what I understand.
Just so you know, so like I did a $2.2 million, 0% down,
Yeah,
no MI
it's unbelievable.
at 5.7
I know, and it's unbelievable. And the rate they get is unbelievable. Yeah, it's
on
crazy.
a VA.
Yeah, I
So
mean, it's
like
a great loan for veterans. It's a
you
great
can go to
loan.
4 million if they can
Yeah,
afford
yeah,
zero
yeah,
down, zero MI. It is the
yeah,
best loan. Nobody
yeah.
even can compare to a VA loan. Yeah.
No, not at all.
Yeah.
So
I could do a $6 million fourplex if I want. There's no limits. It's unreal. Anyway, yeah.
great loan. No, it's a great loan.
Such a good loan. Such a good loan. All righty. Well, it's again lovely to meet you, everybody. All of Alan's information is going to be in the below. And it's been a pleasure. Thank you so much for joining us.
Natalie, thanks for having me.
Yeah, absolutely. Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info, and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.